The font is fine, right, guys? Okay, cool. And hello, nice to see you. How was the test? If I may ask, how did you find the test? It was okay. Okay, right? Okay, cool. No. And guys, don't stress. Don't stress if you think you got something wrong, or don't stress about such things. As long as you did your best, I think that should be enough, right? Okay, so today we are mainly focusing on capital allowances, but obviously now I think for the rest of the year we cannot expect non-integrated questions. Every question you're gonna get is gonna have gross income in it, you're gonna have special inclusions, you're gonna have exempt income, and then that's the year going forward. You should expect more and more integrated questions. But like I say, or usually say, the first thing, please, always you should take note of is obviously the marks and the time. It's not enough to take note of it, but also you should restrict yourself and be disciplined enough that when the 40 minutes is up, you should move on to the next question. It helps a lot, guys, trust me. And okay. And then the next thing you read, you're required. Today we are required to calculate the normal tax liability of Crystal Pty Limited for its year ended 31 March 2023. And like I say, I think it's wise you literally write the 2 dates that every transaction should fall on or in between, right? So that you make it easier for yourself to know when you have a prepaid transaction. And and then we are told to provide reasons for nil effects. So for every time we include 0, we should have a reason for doing that, or for not taking the full amount into consideration. In the income tax calculation, and also we should show all calculations. I'm curious, how many of you showed your calculations, guys? Okay, that's a decent amount. But yeah, guys, if you don't show them, you are literally limiting your ability to score marks, because like I said, in tax we don't mark the final answer. We mark your logic into getting to that final answer. That's where we are 1 mark. If you look at every memo, you'll see most of the marks come from calculations, right? So it's very, very important that you show your calculations, and that's why even the instruction instructs you, that's why you're even instructed to show your calculations. So in this case, you are a tax consultant at Grace Accounting Services Pty Limited. One of your clients is Crystal Pty Limited, a South African resident. This is important because since it's a resident, they'll be taxed on their worldwide income, not income from a source in South Africa. And the company, we are told, specializes in the manufacturing and distribution of crystal wine glasses and Krugerstop. Like I say, this is very important to note for yourself. You should know what your taxpayer is doing, because it makes it easier to understand the type of transactions they get into and how to essentially account for the tax implications. Crystal has a 31 March year end, as we've noted, and SARS considers glass manufacturing to be a process of manufacture. My question to you guys, is that statement important? And if so, what's its significance? What should it mean to you when they say this company's process is considered to be a process of manufacture? What it means is this. It means whenever you get a machine, especially in second year, when you get machines, use section 12 cap C if that machine is used in that process to manufacture that glass, right? Or wine glasses, essentially. But another company may be, say like last week, you may have a company that produces content and they also have machines, but they are not manufacturing anything. So those machines would go under 11E and not 12 cap C. Do you guys understand? Okay, cool. And then we are told to ignore the VAT, the effect of VAT for this question. The senior tax consultant has provided you with the following information for Crystal's year ended 31 March 2023. And like I say, you can just make a note next to that and remind yourself that you are essentially dealing with 1 April 2022 to 31 March 2023, so that you don't forget. And then because you may forget, because everything is still new to you guys, you may forget, and you may end the year on 28 Feb, but if you write it down, at least I think it you are anchoring it in your mind that instead of 28 Feb, use 31 March because that's the company's financial year end. And then we are told income in the form of cash sales of 1,250,000 rands, credit sales 750,000 rands, and dividends received on investment in local shares of 300,000 rands. I think you guys know this by now. So we'll quickly deal with that. All of this is gross income. Do you guys agree? Yes, I agree too. So we have the cash sales and it's 1,250,000, and we have the credit sales, and this is what? 750,000 if I remember correctly. And then we have the local dividends, right? Dividends 300,000 rands. And then my question to you, are the dividends exempt? Yes, right? Easy. This should be easy marks to do. Local dividends, well, let me exempt income. And then you exempt your dividends. Okay, cool. And then we move on to the next question. It says tax deductible operating expenses of 115,000 rands were incurred during the year ended 31 March 2023. Again, guys, you are told it's tax deductible and this is expenditure or expenses, 115,000 rands. So not much to think about there, but to just deduct the thing. Expenses. Any questions so far? Nothing, okay. And then we are told Crystal purchased a floor in a new 10-story building on 15 November 2022 directly from a property developer for 700,000 rands. The building will be used for administrative purposes and was brought into use on 1 December 2022. I'll ask you guys, what do you think is important there and why? Don't be shy. Guys, this is like the perfect space to, yes sir. Yeah? The building is new. Okay, do you still want to answer?
It's also important to note that it's for admin purposes and it's only a part of the building.
Okay, so, okay. So a floor in a 10-story building. So that part is also important, I agree. So we purchased a part of a building. We purchased one floor out of 10. Okay, cool. Any other part, guys? It's also new and unused, so that's very important. Another way we can tell you that it's new and unused, we can tell you that it's purchased directly from a developer or directly from a property developer, and then you should know it is new and unused. And then what other information? Obviously the cost, that's important.
When it was brought into use.
Yes, thank you. When it was brought into use, that's also very important because we may have purchased an asset in the current year of assessment, but if we bring it to use in the next year of assessment, then that means you cannot claim an allowance in the current year of assessment. Do you guys understand that point? In accounting, it's a little bit different. You start claiming depreciation when the asset is available for use. In tax, only when it's actually put into use. Any other part, guys, that's important here, or that's it, right? Okay. Another part, remember, guys, we tell you that you must own the building and you must have incurred the cost to buy the building. That's very important. Remember, if a building is donated to a taxpayer, then there is no cost. Do you guys know that point? So the fact that it's purchased and we are the owners, it's very important. You must purchase and own it. It must be new and unused. It must be wholly or mainly used in your trade. And I think those are for commercial buildings. Those are, I think, the main requirements. And then if you meet those, then you qualify for a commercial or 13 Queen allowance. Right, we meet all of those, so let's quickly claim our allowance. And guys, if you're asking yourself why 5%, it's because the Act says so. Like that's what the X says. It says claim 5%. In other words, they're saying claim it over 20 years. Okay, why does it seem weird? Okay. Any questions, guys? Yes?
Sorry, sir. I thought if they said that it's for administration purposes, you're supposed to disregard that because isn't it only supposed to be for manufacturing purposes? That's when you actually deduct it or get an allowance for it.
Okay, that's a good question. That's a very good question. Remember, guys, you've been lectured on 3 types of buildings, right? You've been lectured on commercial buildings, residential buildings, and manufacturing buildings. Am I correct? Yes, right? You can claim allowances on all 3 of these buildings. In fact, one business can have all 3 of these buildings. A manufacturing company, say Tiger Brands, they make what? Viennas? Do they make Viennas? Do they? I think so, because of that. I don't know. Okay, it doesn't matter. Anyway, Tiger Brands, they make food. They manufacture food, right? They make bread, and I don't know what else. They make food, though. They manufacture food. And so they have their factory. That's section 13, 5% on that. They may have residential buildings for their employees, right? So that they are closer to the factory. That's section 13.6. They may have head office in Johannesburg for the executives, right? That's the commercial building. And all 3 of those they can claim an allowance on all 3. Am I making sense? Yeah, guys? Yes, right. So it doesn't, you are not limited. If the building is used, if it's one of these 3 buildings, because it's part of your scope, there are other types of buildings like labs. I don't know what labs are classified as. Yes, sir?
So because they only bought one floor, isn't it supposed to be a
Oh, yes. You are right. Thank you. That's why I'm like, why is this so weird? Because I don't remember doing like this. But anyway, you're right. So, thank you for that. If a taxpayer buys a part of a building, 55%. If a taxpayer buys improvements or part of improvement, 30%. Do you guys know that part? Okay, cool. So in this case, it's 55%. Thanks a lot for that, man. Okay, any questions? Okay, cool. Let's quickly move on. We are told Crystal has a warehouse, that's what I should be highlighting, in Magaliesberg to store finished goods. The warehouse was received as a donation. So this warehouse was received as a donation on 1 October 2005 from a farmer, Mr. Fenter, who also used it as a storeroom. So he also used it as a storeroom. The market value of the warehouse was 1.5 million rands on 1 October 2005. So its market value was 1.5 million rands. So no brainer, right, guys? We claim our 5%. Do you guys agree? You're shaking your head. Why do you disagree?
Well, I didn't take it into consideration because it's donated.
Yeah?
Because it's donated.
Okay, so because it's donated, there is no cost. Therefore, we do not meet all of our requirements. What's another requirement that we didn't meet? Yes, sir?
It was previously used by the previous owner, so it's not new and unused.
Yes, so it's not new and unused. Not new and unused. Therefore, 0. And remember, we're told to give reasons for nil effects.
So,
Yes?
what if it was new and unused but it was donated? They still
Still 0. Yeah. Because it's an end thing. Like it's an end thing. You should take note of. Yes, sir.
I just wanted to ask that if they bought it and they say it was only used to store finished goods, would you still have deductions?
So if they bought it from a developer and they're using it to store their finished goods, then yes, it's a commercial building. You understand? It's still a commercial building, but it's a commercial building that does not qualify for 13 Queen allowance because first it was donated, second of all it's not new and unused. I understand. Yeah. Any other question, guys? And I was saying you should watch out. Like for tax, you'll see some requirements will say the taxpayer must meet this and this and this and that. Right? Sometimes the act will say the taxpayer must meet this or that's prepaid for prepaid expenditure, section 23 cap H. It says within 6 months or required by legislation or the sum of all transactions which essentially don't meet A and B must be less than 100. For I think uniforms, it says must be required, you must be obligated to wear the uniform and it must be clearly distinguishable from normal or ordinary clothing, and I don't know what else, you must wear it to perform your activities at work essentially, you know, so you must watch out for those so that you know, okay, do they need to meet all requirements or do they need to meet some of the requirements? Okay, so we are told Crystal entered into a lease agreement with Lease's Pty Ltd to lease a factory building. So we are leasing a factory building which is suitable for glass manufacturing. Again, they are telling you this factory building is actually used in a process to manufacture glasses from 1 April 2022. Very important. You should be happy when you see these kind of things because it aligns with your year of assessment. So you don't have to apportion the allowances which you would normally need to apportion if they were brought into use in the middle of the year of assessment. Crystal paid 250,000 rands as a lease premium on this date. What do we do with our lease premium, guys? I didn't go, okay. You are right, but we are told the building will be leased for a period of 15 years. So we divide it over the 15 years, right? What if we entered into the lease on, let's say, 1 June 2022? Would we apportion or would we just divide by 15? You would apportion, right? Yes. And then, let me just quickly fact check myself on that. But I know in general I think it's 499. But in general, guys, another way to, I would say, okay, it's just 11E, 12 cap C, 13. But in general, usually for section 11 allowances, you would normally apportion. If it's an 11, but there are some where you don't, so just make note of the distinct ones. But in general, you would always apportion. Let me just quickly check this one. Leases, lease premiums, yeah, you are apportion it 437. Let's wait for it's premium. Yes, multiply by period, other days or month in the year of assessment used in the production of income. So you do apportion it like we said, but please take note usually, but that's an easier way to remember it, is if it's an 11 allowance, these premiums are 11F, you'd apportion them. But if it's not 11, like section 13, then you don't apportion, irrespective of whether it's brought into use in the current year of assessment. In the middle of the current year of assessment. Now I forgot my page. Okay, so, but in this case, are we apportioning it? Hey guys, why not? Yeah? Yeah, I started on the 1st of April. And then another question is this: what if the lease period was 30 years? Yeah? Yes, it's limited to 25 years, guys. So please take note of that. If the lease period is more than 25 years, you cap it to 25. Okay, we are told the monthly rental payments amounts to 13,500 rands and was paid on the first day of every month. So it was paid on the first day of every month. during the year ended 31 March 2023. And then we are told Crystal made a payment of 94,500 rands on 31 March 2023, which is an advance payment relating to the monthly rental for 1 April 2023 until 30 October 2023. Okay, let's first deal with the monthly rentals for the current year. Okay, let's say rent expense for the current year. It's easy, right, guys? It's minus 13,500 multiplied by 12 or 13 because we're paying it in advance. All in favor of 12? 13? 13? Okay, yes, okay, let me quickly justify. The right answer is 12. But if they said Crystal pays on the last day of every month, then it would be 13 if it was last day of every month, because we'd make the payment for 1 April 2023 on 31 March 2023. Do you guys understand? Then that would bring us to 13 because we would pay for every month in the 2023 year of assessment plus 1 month for the 2024 year of assessment. Then that's 13. But in this case, on the first day of every month, meaning we'll pay for the rent for 1 April 2023 on 1 April 2023, the next year of assessment. So 12 is the correct answer. Okay, and then,
So,
yes ma'am.
if it's like that, doesn't it mean that for the first month, we paid it for in the previous year of assessment?
No. Okay, let's read the statement. It says the monthly rental payments amount to 13,500 rands, and they are paid on the first day of every month, right? I don't know. Okay, yeah, that's another thing. Probably most of you guys don't pay rent. Usually you stay, then you pay. In this case, well, usually you pay, then you pay and then stay, right? That's how it works. And usually, yeah, I remember, because yeah, well, even now I'm paying rent. I pay for the next month's rent in the current month. You understand? But in this case, you pay for April on April, but on the first day of April. Does that make sense?
According to your second example, you say you pay rent at the end.
Yeah, how we normally pay rent is you pay it at the end of the month, but not for the current month, for the next one. So meaning, if you have a cutoff date, let's say for the cutoff date, in this case 31 March, if you're gonna pay for April, you'll pay for April on 31 March 2023. Then that would bring it up to now 13. But okay, in this case, granted obviously that with this information in mind that we started renting on 1 April 2022. So we'd pay on 1 April 2022 and we'd pay on 30 April 2022 for May. And then we'd pay May, June, July, August, September, October, November, December, January, Feb, March. But this March payment would be for April. Then that would bring it to 13. Yeah, but yeah, guys, I should stop making hypotheticals. Because what if you probably never even come across that example? Anyway, we are told here, I want to look at my page, 35%, okay, not bad. Crystal made a payment of 94,500 rands, and this is an advance payment for the period of 1 April to 30 October 2023. This is prepaid expenditure, you guys agree, right? It's even explicitly told, it's said here. And then you just ask yourself, will the benefits, or did you pay for up to 6 months? And we paid for April, May, June, July, August, September. Well, that's the end of the 6 months up until October. So we paid for 7 and not 6 months. So it's not received within 6 months. Then is it required by legislation? No, right? Because it did not explicitly say that. And then what you do now is this. Hence I have this column here. Please, guys, I advise you to have this column here as well, because for whatever payment which does not meet the first two requirements, which is required benefits will be received within 6 months, and also if it's not required by legislation, then you park it aside because in order for you to apply the 100,000 rand requirement, you need to apply it on the sum of the transactions which do not meet the within 6 months requirement and also the required by legislation requirement. Am I making sense? Right, okay, cool. But you'll see it as we go on. So we are told Crystal was unhappy with a particular portion of the building and entered into an agreement with the lessor to effect lease improvements on that part of the building. The contract did not stipulate the value of the lease improvements. However, Crystal effected improvements to the value of 100,000 rands, which SARS deemed to be the fair and reasonable value. You guys know that whenever the contract doesn't stipulate a value, you need to use the fair and reasonable value of the improvements. You know that, right? However, if there was a value contracted or a specified amount in the contract, then you use either the lesser of the amount spent, you use the lesser of the amount spent by the lessee or the amount specified in the contract. Do you guys understand that part? Okay, cool. The improvements were completed on 1 December 2022 and brought into use immediately. Again, a very important statement for you. Okay, let's quickly deal with the leasehold improvements. Lease improvements. Okay, like I always say, guys, you take in this case, it's simple. You take the fair and reasonable value, which is 100,000, and then you divide this amount by the number of months left in the lease. Do you guys understand? I recommend you use months because it gets trickier once you start using years. And the number of months left in the lease is, we entered on the lease on 1 April 2022, and it's a 15-year lease, and the improvements were completed on 1 December 2022. So we used them on December, Jan, Feb, and March. We used them for 4 months, but then meaning 8 months had elapsed in the lease before we used them. Do you guys agree? Yes. So the time left in the lease is essentially the 15 years multiplied by 12 to get the total months in the lease, and then you deduct the 8 months which had elapsed before the leasehold improvements had been brought into use. And then after that, you multiply by the number of months which you have been using the leasehold improvements for. Okay, I think it's nice. I can just copy this now. Does it make sense, guys? Because the previous tutor class struggled a bit with what I was saying here. Okay. Okay, I'll explain it again. So, where am I? Okay, maybe I can just write it here because there's space here. So, in terms of the amount, that's the first step you need to answer. In terms of the amount, if the contract, if the value is specified in contract, right, then you use lesser of either the amount spent by the lessee or amount in the contract. Right, so you'd have to ask yourself, okay, there's a value specified in the contract, it's 100,000, but the lessee spent 150,000. So the lesser between the two is 100,000 because 100 is less than 150,000, you understand? Meaning you take the amount in the contract. However, if the lessee spent less than the amount in the contract, so 80,000, the specified amount is 100,000, then you take that 80,000. You understand that part, right? However, if there is no value specified in the contract, then you take the fair value, essentially. You take the fair value or the fair and reasonable value of the improvements, which is what we're using in this case. And then what you do now is this. You divide this amount by the time left in the lease. So it's like you're amortizing it, essentially. Well, yeah, I think. You are spreading it over the lease period, essentially, right? So you divide this amount you chose here by the time left in the lease, right? In our case, the lease is for 15 years, right? And this 15 years in months is how many months? 15, yeah, 180 months. The list is for 180 months. However, 8 months had elapsed before we started using the improvements, right? So meaning the time left in the lease is 172, right? 172 months. So that's the 100,000 divided by 172 months. And then now you get the lease improvements per month. Then you multiply it by the number of months you've been using them in the current year of assessment, which is December, Jan, Feb, and March, and that's times 4. Any questions, guys? Nothing. Okay. Okay, let's quickly move on then. We are told a number of Crystal's factory employees were transferred to the Nelspruit branch, and Crystal had to provide. Oh, wait, guys, before I move on here. Another very important point, I don't know if you know this, but I think whilst we're here, let's cover it. If the lessee, this only applies to factory buildings. Why only factory buildings? Because with factories, you don't need to own them. You just have to incur the cost to construct the factory. Do you guys understand that difference? You don't need to own it, you must have, though, contributed towards its construction. In this case, we are leasing a factory building, and we've improved it. Meaning we probably added another room for manufacturing, right? So for that room we've added, even though we don't own it because we are leasing this thing, we can qualify for the 13(1) allowance. How? This is what happens. You first amortize. Remember, for this one, we choose for this part, if there's an amount specified in the contract, you choose the lesser between the amount spent by the lessee and the amount specified in the contract. If the amount spent by the lessee is more than the amount specified in the contract, then let's say 150 spent, but 100 is specified in the contract, then you would use 100 like we've used here. But what happens to the 50,000 rands? The 50,000 rands qualifies for that 13(1) allowance. So you can claim the 50,000 rands at 5% per annum over 20 years. Do you guys understand? But, do you guys understand? No. Okay, where do I start? So for factory buildings, okay, do you guys know for residential buildings, you need to own them, right? You guys know that point, right? You need to own residential buildings. For commercial buildings, we've already noted, you need to own them. For factory buildings, you don't need to own them. You need to have incurred the cost to construct them. Do you understand? That's where the first thing you must take note of. In this case, if you are leasing, so this means if you are leasing a commercial building and you incur improvements and you spend more than the amount specified in the contract, the excess that you've spent, you cannot claim it under Section 13 Queen for commercial buildings. Why? Because there you won't satisfy that requirement that says you need to own the building. You understand? However, if you are leasing a factory building, which is the case here, and you spend more than the amount specified in the contract, then 11, this is 11 what? 11FG. This is 11G, right? Okay, you don't need to know that. Let me not confuse you. If you spend more than, for lease improvements, it will limit you. Because it will say, you'll take the lesser between the amount spent and the amount specified in the contract. And if you've overspent, then it means you'll take the amount specified in the contract, 100,000 for an example. But then the question now is, what happens to that excess? You spend 150, you can only claim 100. That excess, which is between 150 minus 100, you can claim it on Section 13(1). Because for Section 13, you don't have to satisfy a requirement that says you must own it. Because the only requirement you must satisfy there is you have incurred the cost to construct these improvements. You understand? Yes, sir.
So you said you deducted 400,000, right?
Yes.
But is it not supposed to be 30% of the improvement?
No, because we didn't purchase the improvements.
It's because you only affected them. So
We've built them. Okay, guys, do you understand? Okay, let's come here. We do not own these improvements. Do you guys understand that point? Because we are leasing the building. So these improvements belong to the lessor. However, if you go and you buy an improvement, there's a factory building here and they've just added an extra wing to it. And then you say, you know what, I don't want the old factory, I only want to buy the new wing of the factory building, say it's in an industrial park somewhere or industrial zone, then in that case, that's where the 30% comes in. You are buying it, you are not leasing it. You understand? In this case, we are leasing, and then we are contractually obligated to effect improvements on it. Right? We don't own it, but we've incurred the cost to effect the improvements on it. Then it becomes unfair if you think about it now that even for commercial buildings, I don't know why, but it's still unfair because you've built a new building, you've added value to the economy. But anyway, they say no, you must own it. You know, maybe there was a scheme run by taxpayers where, yeah, that's weird, right? But yeah, but do you guys understand the extra 5% thing, but only for manufacturing buildings? Do you understand? Okay, cool. Okay, I think we're done here, right? Yeah. We are told that a number of, let me check my battery before I run my mouth. Okay. A number of Crystal's factory employees were transferred to the Nelspruit branch, and Crystal had to provide accommodation to the employees. Crystal purchased the land adjacent to the manufacturing building for 125,000 rands on 1 July 2021. Guys, easy peasy, easy marks. There is no allowance on land, right? Do you guys agree? Yes, guys, no allowance. It's an asset, non-depreciable asset. That can be your reason. Same way, there's no depreciation on land in accounting. Or non-depreciating, I don't know the correct English. But I have a question on this. What happens to the land in war zones? Because to me that seems like it's, don't you think like if a country has been bombed a lot, like the land should be valued a little bit lesser? Because you have to like do things to that land. Maybe you have to level it and whatnot. What do you guys think? Okay, you guys not in the mood. Okay, fine. Okay, but for the land, nothing, no allowance. And then on 1 August, the construction of an apartment building, again, you take note of that, it's an apartment building, so residential building, right? For Crystal, commenced and was completed on 1 April 2022. Guys, for tax purposes, this date has no significance. For accounting, it has a lot of significance, but for tax, nothing. That's the date it was completed, not brought into use. The apartment building was occupied on 1 May 2022. Now, this is the date you are looking for, because that's when it was brought into, or it was used in the taxpayer's trade. Do you guys understand? And then when the employees moved in, the apartment building comprises of 7 units. Is this important to us, guys? Yes, because remember we have to satisfy at least 5 units. And these 5 units must be in South Africa, guys. So you can have 4 units in Pretoria, 1 unit in Harare in Zimbabwe. Then what would happen is this: you'd get taxed on all the rent income you earn in South Africa and from Zimbabwe, right? Because you are a resident. However, you cannot claim the 13 sex allowance. Why? Because even though you have 5 units, 1 of them is in a foreign country and 4 are in South Africa. Do you guys see? So you wouldn't qualify that way. And can thus accommodate 7 employees. The unit cost of building each apartment amounted to 225,000 rands. Is this significant to us, guys? Why? Yes, sir.
Because if that amount is less than 300,000 and the rent is less than 1%, you get that additional 5% allowance.
Okay, do you guys agree with him? All of you? Yes, sir.
The cost has to be less than 350,000 for apartments.
Yes, guys. Yes. So for a okay, let me not write this down. I'll take time. For a standalone unit, do you know the difference between an apartment and a standalone unit? No. Okay. An apartment. Who of you stay or knows about apartments on William? You know about it, right? Only a few of those apartments are actually built on land. The others are built on top of other apartments. Do you understand? So it makes sense why they say when you are calculating that 1% thing, do not include the cost of land, because most apartments usually won't be built on land because it's just built on top of another apartment, right? But a standalone unit, it's like a 4-bedroom house. Like it's there, it's a 1 unit built on land, all the rooms are on land. So include the cost of land when you're calculating the 1% thing. Do you guys understand? Yeah, that's another way to think about it. Okay. Each employee paid rent of 2,000 rands per month. Okay. So one thing again to note about this question is it has a lot of moving parts. I don't know if you noticed that. Like there's a lot of stuff packed into one paragraph. The first thing we need to take note of is we must the rent income. Do you guys agree? Because we are leasing these things to our employees. So we have rent income, and we are told that it's 13,500 rands, if I'm stand to be corrected. No, it's 2,000 rands. Wow. 2,000 rands times 7, because the 7 units, times 11, right? Because we didn't use them in April. They were only occupied on 1st May 2022, right? And then another part is what we've just discussed now. The cost of the apartment is 225,000 rands, and 225,000 is less than 350,000, so we check that box. And it's an AND test, so you must meet both requirements. The second requirement is this, that the cost, the rent charged on the apartment must not be more than 1%. It can be 1%, but it must not be more than 1%. So in this case, 1% of 225,000 rands is what, guys? 2,250, right? And our rent is 2,000 rands. So 2,000 is less than 2,250 rands. So we meet that requirement again, right? Okay, cool. Then now we claim our allowance. Let me just say apartments. When we are claiming our allowance is 225, okay, minus 225. It's 7 of them, and it's 5% times another 5%, right, guys? You guys agree, right? Because you qualify for the extra 5%. Do you guys agree? No, guys, you cannot. You must multiply it by 10%. Because if you do it like that and say 225 times 7 times 5%, you get 5%. And then you multiply it by 5%, and then you get 5% of 5%, which is wrong, right, mathematically. Because remember, the excess, the taxpayer qualifies for an extra 5%. So meaning, instead of claiming 5%, now claim 10%. You understand? But mathematically now, you must remember not to say times 5% times 5%. You must just say multiply by 10%. Okay, cool. Any questions, guys? Nothing, right? Where were we? I think we are done here. Yeah. Okay, an amount of 36,000 rands was paid in advance. Again, this is a prepaid expenditure by Crystal on 30 November 2022 for the electricity of the residential units relating to the period 1 December 2022 to 30 November 2023. Again, this is for 12 months. How do we know that? Because we paid for 1 December up until the last day of the previous month, but in the next year. So 30 November. So that's a 12-month period. You guys understand, right? So meaning, since it's for 12 months, we don't meet the within 6 months thing, right? And we don't meet the required by legislation thing, right? Because we didn't tell you that it's required by legislation. So, but remember now, this is tricky because 1 December 2022 up until 1 December 2022 up until 31 March 2023. Okay, I don't know what happened there. Oh well. Is even okay. Is within the current year of assessment. Do you see that? So meaning December, Jan, Feb, March, that's in the current year of assessment. And then April, May, June, July, August, September, not meeting the 6 months thing because we have 8 months left now out of the 12 months does not meet the within 6 months requirement. But let's quickly do that so that you see it. Okay, so in the current year, we have the 36,000 multiplied by 4, December, Jan, Feb, March, out of the 12 months, right? But in the next year, it's the 36,000 multiplied by 8 out of 12. So you still do not satisfy the within 6 month thing. You still do not satisfy the required by legislation thing. And then now we must just determine how much is this, right? So 36 times 8 over 12. 24,000, so meaning here, that's 12,000. Right. So once you are in this position, remember I told you to park the amounts that do not meet A and B. In this case, I know this because I've been doing the question so long. But I know this is the last prepayment essentially that we do not satisfy. So you can go ahead and calculate your sum, right? And our sum, and I told you, you don't apply those the C requirement to one transaction, you apply it to a group of transactions. Once you have all the prepaid expenditure which did not satisfy A and B. In this case, their sum is 118,500 rands. And that's more than the 100,000. So what this means is this: you can claim 0 here, and you must claim 0 here. These amounts will only be claimed in the next year of assessment. Do you guys understand? Because they do not meet within 6 months, they do not meet required by legislation, and they definitely do not meet the at least, the less than 100,000 requirement. So they are deductible in the next year. And then let's quickly move on. We are told here that Crystal paid the relocation costs on 31 December 2022 relating to an employee that had to relocate to the nail sprit plant, and they paid for transportation and accommodation, the guest house. It's for 1 Jan 2023 up until 31 March 2023, and it's 4,000 rands per month. So that's easy, guys. That's 11A relocation, and it's literally the minus 9,000 rands which we paid plus minus 4,000 times Jan, Feb, March, 3 months. And then that gives us that deduction. Any questions there? Okay, cool. And then we quickly move on to, I believe, the last part of the question. No, it's not the last part. Crystal purchased a new manufacturing machine from an unconnected person. What this means to you is this: it's safe to use the transaction price, because if it's an unconnected person, that's probably the market value of the machine. So you can use the 150,000 rands to calculate your allowances on 1 March 2022. And this 1 March 2022 falls in the previous year of assessment. Do you guys agree? Crystal paid installation cost of 8,000 rands on 1 April 2022, which is in the current year of assessment, right? So that's correct. And the machine was brought into use in the manufacturing process on 1 June 2022. And that's the most relevant date to us, because we want to know when was it actually brought into use. And we are told SARS allows a 6-year write-off period. And I've been telling you guys this: don't fall for that trap. Because if we told you this, that SARS considers glass manufacturing to be a process of manufacture, then if the machine is used in the process of manufacturing, like is the case here, they are using this machine to manufacture their glasses, but it's not explicit, but yeah, you can assume that. So, well, yeah, they're in the manufacturing process actually. So it is explicit. Then use 12 cap C, right? The requirements there is that it must be, you must check now if it's new and unused, 40% in the first year. If it's second hand, then 20% throughout the 5-year period. Do you guys understand? And then back to accounting, you must capitalize your installation costs. So with the machine, it's the 150,000 rands plus 8,000 rands, which gives us minus 150,000 rand, minus 158,000 rands times 40%. And that's the allowance. Do you guys agree? Okay, I'll write it out. And then you do not apportion this allowance. That's another thing, guys. In your mind maps, when you are summarizing this section, please make sure you know which ones you apportion and which ones you don't apportion. For buildings, you'll never apportion. For 12 cap C, you'll never apportion. But for 11E, you'll apportion. Lease premiums, you'll apportion. Improvements, you'll apportion. And then, but I think there are others. I don't want to generalize and say whenever it's say section 11 allowance, then you should apportion. Because I think there is, I've just forgot which one. There is one where you don't apportion. Okay, but that's it. And then we are told Crystal has a balance. Yeah, this is a very important part, guys, which I forgot to elaborate on last week. Well, the previous tutorial. Pretend that is 1.3 million. Well, don't pretend, I'll write it out. So Crystal has a an assessed loss of 1,300,000 rands from the previous year of assessment, right? So whenever you get this question, the first thing to be mindful of is the year end. If the year end is on 31 March 2023 or forward, and then you must limit the assessed loss. However, if the year end is before 31 March 2023, then you must deduct the full assessed loss. Do you guys understand? Goes back to that thing. If the company's year of assessment is on 31 March or going forward, 27%. But if it's before 31 March 2023, 28%. You guys know that, right? Okay, cool. In this case, I forgot to, but it doesn't affect the solution for last week because in any way, the higher amount, the assessed loss was lesser than the higher amount. But this is how you do it. So the first step is you must have a total of your taxable income before you consider your assessed loss. Okay, so that's our total right there. And then after you have this total, you must limit the assessed loss to higher of these two amounts. I'll just put them down here. 1 million rands, right? Or 80% of taxable income before assessed loss. So essentially 80% of that amount. So you will limit the assessed loss to the higher of these two amounts. And like as you can see, guys, which one is higher? Here. Don't be shy, guys. Which amount is higher? But yeah, hey, let me pick, because I've seen in test, I've seen someone say 618 days is more than 915 days. But yeah, there must have been test duress. But guys, the key point is this: our assessed loss is 1,300,000 rands, right? However, it's limited to the higher of, or to the highest amount between 1 million rands and 80% of this total before we consider the assessed loss. Do you guys get it? So in this case, it means for the assessed loss, we can only deduct the 1,268,046 amount because that's the higher amount between 1 million and 80% of the taxable income before the assessed loss. Do you guys get that part? Okay, cool. So let's quickly do that. 1,268,046. Okay. And then what about the excess? The excess is carried forward to next year of assessment, which in this case is the 2024 year of assessment. And the excess is equal to what? $31,954. Do you guys understand this part, or should I explain it more? But the key thing, again, like I've said, you first check the year end. So if the year end of our company was 28 Feb 2023, you just deduct that 1.3 without doing anything, and that's what we are used to. But this year they decided to change it. This year they changed it two ways. They said if the year of assessment is on 31 March 2023 going forward, the tax is calculated at 27%, and also the assessed loss is limited to the higher between 1 million rands and 80% of the taxable income before you take into account your assessed loss. However, if it's before that, then you deduct the full amount and you calculate tax at 28%. Okay, so now our taxable income is then, okay, why does it want a name now? Okay, this is weird. 317,012 rands. So that's the taxable income. Okay, guys, yeah, let me finish. And then our tax liability is 27% of this. Because again, which is 85,593. That's our normal tax. That's the chart, guys. Any questions? Yes, sir.
Explain in the style, like if we get in an assessment that this amount of the assessed loss will be carried forward to the next year of assessment.
Oh, okay. So this one, right?
Yes.
Yeah, this will be carried forward to the next year of assessment. So meaning next year you'll do the same thing like we've done, right? And then when you get to this part again, since it's 2024, meaning it's after 31 March 2023, you then have to limit it to the higher between 1 million and whatever your taxable income is for that next year, but 80% of that taxable income. Do you understand? Okay, cool. But yeah, it's not like in a way they are saying don't claim 100% of your assessed loss. That's what they are doing. They are limiting the claim, but it's still the same thing. Any other questions, guys? Nothing? Okay, let's sign the register. And let me stop recording.